To the untrained eye, and even to some academics, movements in the markets just appear random. We sometimes go up, we sometimes go down, nobody can predict future news, and so all information apparently is already efficiently priced into the market. But I don't think that's true. I do think that there are some patterns. Really, investing is all about pattern recognition. It's all about figuring out, is an asset class currently cheap? Is it currently expensive? What's our long-term expected value? And at what point in time is Bitcoin, for example, very cheap? When should we buy more? When should we potentially sell? In this video, we're going to look at data points that historically worked very well in the past and that still might have some validity in the future as well. Now, no mathematical model is perfect, but some are useful. There's, for example, the 200-week moving average for Bitcoin. Back in the days, there was the story that the Bitcoin price should never sustainably fall below the 200-week moving average. Because there's the 4-year cycle, as in every 4 years, Bitcoin's newly issued supply gets cut in half. That is called the halving. Annually, currently, Bitcoin expands by roughly 0.85%. And so because of that rhythm, people thought that the price would never fall below. But then history has written another story. We actually did fall below the 200-week moving average. Just have a look at the price development since 2022. The moving average was at 24K, yet the price fell all the way down to 16K. So the model clearly wasn't perfect, but it did show us at what point in time is Bitcoin at least comparatively cheap. Now currently the price floor is at around 52K, but again we might fall below that. There's an alternative approach that hasn't yet failed, and that's the Bitcoin power law. So over here we simply see a regression line through Bitcoin's historical price data, and then we just shift that regression down. After that shift, we get a somewhat reliable price floor. At least with the drop in 2022, we didn't go below that floor. And currently, that's at 43K. Now, by no means am I saying that Bitcoin will fall to 43K tomorrow, but it simply goes to show that in case we enter a bear market at some point, how much volatility there really is in the Bitcoin price. Bitcoin did lose 80 and 70% in prior bear markets. Here's a model that's not so useful anymore. It used to be very popular. It's a stock to flow model. So that's a prediction of the price, again, based on the Bitcoin halving cycle. The idea is that because Bitcoin's newly issued supply gets cut in half every 4 years, Bitcoin becomes more rare. And because it becomes more rare, it should also go up in its price. Something that's not as available should be more valuable. And there was a cross-asset analysis done by an analyst called Plan B, and he looked at various precious metals, checked how much new supply hits the market, relatively speaking, to the stock. So what's the flow to the stock? And that then gave an estimate of how market cap and newly issued supply should be connected. But what we can see with this model is that first of all, the current prediction is way above the current price by more than 10x. But what we also see is that in the past, the price did overshoot the prediction quite a bit. And then with every cycle, it overshot less and less. And so it's just natural to assume that the model is probably overestimating the impact of the halving. In the end, this is only a supply-driven model. It doesn't look at the demand at all, but it's demand plus supply that determines the price. Now, since Bitcoin grows larger and larger in market cap over time, it takes more and more US dollars in order to push the price further up. Because of that, we tend to see diminishing returns. As in, when Bitcoin was just worth a few $100 million, then of course it doesn't take that much money to double the price. Now that it's at many hundred billions of dollars, it does take a lot of money. And so when we look at the historical Bitcoin chart on a logarithmic scale, we can clearly see how initially the slope of that line was more steep than it's recently. So the growth in percent is slowing down. What's interesting is when we look at the performance of Bitcoin relative to its volatility, because the volatility is of course also coming down, right? The price movements both to the upside but also to the downside are slowing down. When we look at the ratio of gains to the volatility risk, this tends to hover in a somewhat stable range. As in, we tend to be very high in the Sharpe ratio when we peak out in the price. We tend to be very low in the Sharpe ratio when we bottom out in the price. Now, there's several ways we could potentially draw the range here. we could simply go with horizontal lines, and then the current price would be rather in the middle. We are in a balanced market. There is a case to be made to just draw it this way, because we only got one outlier over here, and we've got a bit of an outlier over here. But we could also look at this slightly differently. Have a look at those lines. This also makes, to a degree, some sense, because now the tops here align, and those other secondary tops, they also align pretty well. And when we just look at the parallels, we also have aligning bottoms. So what's the real story here? Nobody knows. But in case the Sharpe ratio is actually also declining, so actually the returns are declining faster than the volatility, that's what a decreasing slope here means, then we might already be quite high in Bitcoin historically. And then there is a chance that we come further down. And we've already looked at the potential bottom just a few moments ago. Now, what's a potential top? We can have a look at the terminal price. Now, in the past, we slightly overshot that terminal price. We overshot it less and less with every cycle. And so probably $244,000 is really the absolute tippy top of this current cycle. It probably makes sense to already take profit earlier than that. Again, because we tend to overshoot less and less, and we might not even reach the upper end this time. A very similar dynamic to the stock to flow model, right? Where initially we overshot and then we came lower and lower. And then finally with the recent run, we didn't even hit the price target. Now we have seen quite significant shifts of the investor base, of the kind of investor in Bitcoin over the years. In the very early days, we had the cypherpunks, right? We had the people that might have used Silk Road to buy some goods that weren't that easily available anywhere else. Afterwards, we had the small retail investor that tended to buy maybe via the centralized exchanges. Now we get the rotation towards Wall Street, towards the ETFs and the treasury companies. What we're seeing with all of those rotations is that actually the usage of the Bitcoin blockchain is not going up. Bitcoin is getting more and more used as a store of value, less as a transfer mechanism for value. We are storing, we are not transferring. Have a look at the number of active addresses on the Bitcoin blockchain over time. We do not see any growth anymore in the last 8 years. Yet the price did do another 5 to 6x since then. Here's the number of new addresses over time. Again, no growth in the last 7 to 8 years. Have a look at the number of addresses that have up to 0.1 Bitcoin, so a bit over $1,000. The number of such addresses is going up. It did slow down recently. Now it's starting to tick up again. Have a look at the number of Bitcoin addresses of 0.01 to 1 Bitcoin. So that's now the range from $1,000 to $100,000 roughly. That's how we could measure the number of the average private investor that has self-custody of their Bitcoin. And that also tended to top out somewhere around 2 years ago. And it's not going up anymore, yet the price did go up massively since then, right? It did do a 3 to 4x. But again, the number of self-custody private investors is just flat. Here we're going one magnitude higher. So that's now from 1 Bitcoin to 10 Bitcoin. So 100K up until $1 million roughly. The same kind of development. And one more order of magnitude up. This is now from 1 million to 10 million. So this includes quite wealthy people as well. Where do we actually see the growth? The answer is here. From 100 Bitcoin to 1,000 Bitcoin. So that's $10 million up until $100 million. So this could already be counted as institutional money, right? This is some ETFs, this is some treasury companies, and maybe absolute ultra high net worth individuals, the billionaires that might have this as a secondary allocation. So really, it's the big money that's currently pushing up the prices. This is why we've seen the recent doubling in the Bitcoin price. It's just because the number of those investors went up. Going another order of magnitude up, we actually do not see that growth anymore. And so to a degree, Bitcoin is much closer to digital gold than it is to digital cash, because Bitcoin isn't used for transactions that much. It's used as a store of value. It's used just to preserve purchasing power over time. And most small retail investors already have a sufficient allocation, but the Bitcoin treasury companies, they continue to accumulate at a very quick pace. So in the last year, this went from 500,000 Bitcoin to 1.1 million Bitcoin, 0.6 million Bitcoin or 600,000 Bitcoin was purchased in a very short amount of time. And on top of that, we've also got the ETFs that are buying constantly. And that's the big difference to prior bull runs. In prior bull runs, we saw the retail investors pushing up the price more and more. There were more and more retail investors coming in that wanted to ride the current momentum, and they were always a bit anxious to potentially sell in case the current rally doesn't continue. That then starts the bear market, right? If there aren't enough new people coming in to push the price even higher, the price doesn't appreciate much more anymore, then people get anxious and sell off and create the bear market where we then go down by 70 or 80%. But this time, the type of investor that's buying into Bitcoin tends to, in aggregate, just buy and hold. The balance of the ETFs, the balance of the treasury companies is steadily increasing. It's pretty much monotonically going up. Thus, the liquid supply of Bitcoin is shrinking. And that is what's changing the game right now. In the last month, we have seen a supply absorption through the ETFs of 2.5%. So that's when we annualize the inflows. On top of that, we've also got the treasury companies that at least purchase at the same rate. Maybe they purchase even faster. So maybe both of those entities combined, they buy up 5-6% of the entire Bitcoin supply every year. And that matters because at the same time, we've got only Bitcoin mining of 0.8% per year. So there's roughly 5% of Bitcoin supply that gets stashed away every single year, which of course makes it indeed a good store of value. We've also got some Bitcoin that gets lost over time. So here's the Bitcoin that has not moved in the last 5 years. And while every now and then we might see a few of those long-term dormant Bitcoin suddenly getting moved, the very long-term trend is clear. So we've got Bitcoin that gets lost, we've got Bitcoin that gets purchased via the treasury companies and via the ETFs. And to top it all off, we've got the inflation rate, right? 3.3% historically every single year. It fluctuates. Sometimes it goes up after COVID. Sometimes it comes back down. But actually, it's not the inflation rate that pushes up Bitcoin. It's rather the monetary base expansion. And the monetary base in the US goes up by roughly 6.8% per annum. So in the last 66 years, we have seen the monetary base expand by a 77x. So that's 6.8% of devaluation of the US dollar. The only reason why the official inflation rate is lower is because those numbers are tinkered with and because the things that the inflation rate is measuring, they tend to be deflationary in nature. They tend to be easier and easier to produce over time, right? We've got technological progress, and that of course makes goods cheaper to produce. And that impact should push down prices. And I do believe it does push down prices, but not enough to counteract the 6.8% monetary base increase. So really, the hidden tax is 3.5% per annum. That's how much purchasing power people are losing over time for things that are not getting cheaper over time, where technological progress doesn't have too much impact. And so all of those models are useful to a degree. They can give us an idea whether or not we are currently cheap or expensive. They can give us an idea at what point in time we might top out. They also show us the current drivers of the Bitcoin price, which is not the retail investor. It's all just institutional money. But luckily, that institutional money tends to just buy and allocate. They tend to just set and forget. And that is what keeps me rather calm over the long term. Yes, Bitcoin might get into another bear market, but I'm diversified. I also own a lot of gold. And if currently we see a massive crisis everywhere, maybe traditional finance has a black swan event like COVID and it spills over again to Bitcoin, that's fine because I also own some gold. And then I can buy up that bottom when most other people are panicking. As long as the institutionals don't exit the space, everything should be okay. Bitcoin is becoming more and more rare, while fiat currency is becoming more and more abundant. And that differential is really what makes Bitcoin a great long-term store of value. Now, here's a common misconception. Most people think that there's some kind of a direct connection between risk and reward. As in, if we are willing to take on more risk, we should also get more reward long term. But it's actually not true in crypto. This is the smaller altcoins and their performance in the last year. There are two altcoins out of those 100 alts that actually did better than Bitcoin. There is Purple Pepe and there's the Cult token. Bitcoin during the same time almost doubled. But have a look at all of those other tokens. It's to be expected that the majority loses, but is it really expected that in case you get the winner, you only outperform by 250%, or in this case, only 35%. Had you bought a somewhat diversified portfolio of those altcoins, you're pretty sure to have lost versus just buying and holding Bitcoin. And again, a diversified portfolio of those tokens is definitely more risky than Bitcoin is. So really, there is no direct connection between risk and reward. We always have to figure out what's the best risk-adjusted return in the market. Or have a look at this, the Pump.Fun ecosystem that recently starts to get some traction again. How many people actually make money with Pump.Fun? The answer is very, very few. 99.6% of Pump.Fun traders have not made $10,000 in profit. And I would argue that $10,000 of profit isn't even that much in crypto. It really poses the question, does it make sense to enter a game where there's a 99.6% likelihood that the game will not end up that well? There's all kinds of reasons for the long-term underperformance. There is a potential selling by insiders that simply scoop up a lot of tokens very early on and then sell as the momentum increases. There's also secret over-the-counter dealings, as in big venture capital firms that might buy up tokens for a discount and that then dump those tokens once they release, once the vesting period unlocks. That's what happened here with MantraDAO, with the Ohm token. That went from above $8 all the way down to 21 cents, right? More on this was discovered in the interview by CoffeeZilla with the founder of MantraDAO. But most of the time, the declines in the price aren't that dramatic. They're simply just gradual underperformance because of gradual unlock. What we're seeing here is the weekly unlocks of the altcoin market. It tends to hover at around $1 billion. So if there's not at least an additional $1 billion worth of demand every single week, we tend to see underperformance of the alts. By the way, Bitcoin has a weekly mining of roughly 300 million only, and Bitcoin is much larger than the entire altcoin market. And of course, Bitcoin also gets purchased through the ETFs and through the treasury companies, which cannot be said for the majority of smaller altcoins. And so that's why Bitcoin tends to do better than most altcoins most of the time. Let's have a look at a token that will see some unlocks. For example, here, the Ape token. This is the circulating supply over time. And again, if demand doesn't grow as quickly as supply, then the price has to go down. And so this is Ape relative to the US dollar. And this, of course, then opens the question, does it potentially make sense to still make money with this? Because there are various instruments to bet on falling prices and make money with falling prices. The problem with doing that is that sometimes we do have our rallies as well, right? This is a rally of 270% in Ape. A lot of those smaller rallies have something to do with the market in general going up, because there's all of this correlation, right? When Bitcoin goes up, when Ethereum goes up, then most altcoins go up as well, and vice versa. So just betting on falling altcoins plain and simple like this is very risky as well. But there is a solution. We can bet on falling prices of ApeCoin in this example, at the same time rising prices of Ethereum. Now this chart looks much less volatile than this chart, right? There's less short-term rallies and we see more constant underperformance over time because now we filter out a lot of the macro development. Betting on falling prices like this is much better. So we're basically flipping this chart around. We're going short Ape, we are going long Ethereum, we get this performance. And there is a levered effect. So for example, had you opened that position 2 years ago, you would have made 476% gains, while the supply of Ape tokens didn't even double during that time. So the leverage effect works in both ways. An additional dollar into the ecosystem increases the market cap by more than $1, but also every dollar that's getting pulled out of the ecosystem tends to decrease the market cap by more than $1. It works both directions. And so this here is the performance on logarithmic scale. This is the same on a linear scale. And this is the way how I personally make my money in crypto. I don't try to find the next 10x altcoin that's likely going to burn us. I simply just bet on the market structure. The market structure is that the venture capitalists and the early investors and the team, etc., all those insiders, they tend to offload tokens over time. There's constant selling pressure on many altcoins over time. Just think about this logically. What would you rather try to do? Find the one or two altcoins that are green on this screen, or just flip this entire picture around and everything that's red becomes green and everything that's green becomes red. Suddenly the odds are in our favor, right? If we bet on falling prices of altcoins relative to the rest of the market. I have followed this strategy for the last 4 years, and had I just dollar cost averaged into Bitcoin, I would have gotten the return that's shown here by this light gray line. But instead, because I also bet on falling, very poorly performing altcoins, I got the performance that's shown in the black line. So we can generate relatively consistent outperformance. Yes, there are a few months where we're just going sideways and where we don't necessarily make money, but the overall trend is very clear. And so it might seem a bit complicated, right? We're not just buying an altcoin, we are betting on rising prices and on falling prices. And we don't even just use the spot market, we're even using perpetual futures. So we use derivative contracts. It all seems a bit complex, but in the end, it's actually not that hard. I have made dedicated videos on the topic, and you can simply just watch those videos. The most important ones are over here, using perpetual futures to bet on relative valuations, and also extremely important, risk management with relative valuation bets. Once you've watched those two videos, which in total is just 1 hour of content, you know exactly what to do in order to get performance like this. I'm so confident in this strategy that after you have watched those videos and you've joined the community, I will send you my favorite trade. Now, my favorite trade is not anymore betting on a falling ape price, because the circulating supply of ape will not go up that much anymore, relatively speaking. But I will show you my favorite trade, and if you do not make money with that favorite trade, when you've joined Premium and the favorite trade didn't make you money within the first month of holding the position, then I will refund the Premium membership fee to you. So just join the trade, see if you make money, and if you don't, then this $125 are never spent. I will just send this back to your credit card. There's also a way to pay for Premium in crypto that's also described on the page that's over here. The minimum duration for crypto payment though is 3 months. So you might want to start out with credit card first. I am of course sharing every single trade that I make. So I'm not just sharing my favorite trade where there's the money back guarantee. I'm sharing every single trade as I make them in real time in the chat. A link to Premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in Premium. Cheers.